Hello, and welcome to the Block Solid podcast, where we talk about the evolution of the property market, the newest technologies that enhance and revolutionize the world of real estate and technologies as we know it, and how we, the owners, the buyers, the renters, the investors, the inventors, and the entrepreneurs can benefit from it all. I'm Yael Tamar, co-CEO and co-founder of Solid Block, pioneer in real estate tokenization, and today I'd like to welcome a very special guest, Jason Jones. How are you, Jason?
Hi, Al. Nice to be here. Thanks for having me.
Of course. So Jason is the Chief Commercial Officer of Centrifuge, a venture-backed early-stage blockchain startup that wants to change the rules of global trade and foster economic opportunity. You spent 13 years as a tech analyst, right, including 7 years as a founder and CEO of HighStep Capital, a data-driven, tech-focused hedge fund. Then you spent 5 years as a co-founder and CEO of Cardinal Group, which launched the fintech media and events company, Lendit. And as I found out, you have an awesome podcast there and done over 300 episodes that I already subscribed and looking forward to listening extensively. And also, you launched a world's first alternative credit robo-advisor, NSR Invest. That's actually super, super interesting to me as a finance person, looking forward to learning more about that. So I want to talk a little bit about DeFi. As you wrote, this is your quote, DeFi is the internet native form of finance and it reshapes financial services at its core. Can you unpack that sentence for our listeners and also generally talk about what DeFi stands for, decentralized finance?
Absolutely. So I feel like my entire career has been about riding the waves of the internet. I started in the mid-90s as a tech analyst covering the internet sector. I was one of the first internet analysts on Wall Street and went from the sell side to the buy side, and then had my own fund and invested in hundreds of internet companies all over the world, and then expanded that to venture. So was doing public and privates, and then expanded that to credit and was kind of using data to kind of pick loans. So everything I've done has been kind of internet driven. And when the blockchain came around, I just saw that as an evolution of the internet. I still believe that. So I believe that all commerce will one day run on kind of real world DeFi protocols. While that seems like a stretch now, it's like saying back in 1995, all businesses will run on the internet. So for the most part, that's the case. I mean, maybe not all businesses, but for the most part, that's the case.
Yeah.
So if I had to break that down, I would say the reason why I think that it's so fundamental, and I believe it's part of the internet, it basically comes down to three things: smart contracts, protocols, and DAOs. So let's break them down. Smart contracts. Smart contracts are rules that are digitized, right? Mm-hmm. You may have I'm in the fund business, so you may have a fund that says, we're not going to invest more than 25% in emerging markets, right? Currently, that's a rule that you write into your private placement memorandum. And then once a year, auditors audit your books. They look to see what your performance has been like and whether you have violated any of the rules that were in the PPM.
Right.
That's nice. I mean, that works. But wouldn't it be nice if it was automatically built into a smart contract? That rule is built into the smart contract. And then if succeeded, the contract can't execute. So it's built in automatically. So from that perspective, all rules will be digitized in smart contracts.
It would be nice if you had sources that are feeding into the smart contract, as they call them, oracles. So I'm not sure that you have company databases to that extent that we can use for smart contracts right now, right? So it would be nice in an ideal world if we had those sources feeding into the smart contract.
And that's coming. Number two is protocols. So let's say you have three smart contracts. One says no more than 20% in emerging markets. The second says no more than 10% in large cap growth. And third says, no more than 10% in real estate. Mm-hmm. Now you need a protocol that basically links those three smart contracts that says, once this smart contract is executed, move to the next one. And when that one's done, move to the next one. It's just the chain of events and tells how everything should flow. So once you have the rules, you have the protocol that connects all the rules.
Right.
The third is the DAO. And the DAO is a decentralized autonomous organization. It's a mouthful to say. It's even weirder in person. You're basically saying that it can be a community-driven decision-making engine. We need to figure out what the percentages should be in emerging markets, in real estate, and in large cap growth. Right? The DAO, as a community, votes on that. And once it's voted on, it's implemented in the smart contracts. So by having these three elements, a smart contract, protocol, and DAO, you can basically create commands and execute them on the blockchain. And this becomes decisions that are executed by smart contracts within the internet. It's an evolution of the internet and something that I think all commerce will use in the future.
For sure. And this is hands down the best explanation I've heard of about that, Jason. So thank you for that. And I think it's going to make things a lot more clearer for many people here.
Awesome.
Amazing. Okay, so now take what you just explained and talk about Centrifuge in light of those three concepts.
Absolutely. So Centrifuge is a real-world DeFi protocol. And what we mean by that is that we take real-world assets and we bridge them to decentralized finance. I'll break that down. Let's say we have an asset originator that makes loans. Could be consumer loans, small business loans, real estate loans, doesn't really matter. They are in the business of making loans. They need to raise money at a low interest rate, and then they lend out at a higher interest rate, and they take the spread as their payment for doing so. So they're constantly in the search for capital and lower cost of capital. That's their entire business. The more as they can drive down their cost of capital, they can borrow more money at a low rate, and then they can lend it out at their rate, and they can make the spread. When they start, it's really hard to start these things because cost of capital is really high for a startup.
Yeah.
But as they scale, cost of capital comes down over time. You may start by getting money from a hedge fund that wants to generate really high returns, so was willing to take early stage risk in exchange for generating high returns. They know they're going to be transitioned out once the originator starts growing, but they like getting there early and getting the fat returns. The originators kind of moving their way down the cost of capital curve. Maybe they switch to a family office or something that wants something that's a little more mature, but still generates some nice returns. Maybe it rolls from there to a bank. A bank says, okay, now you've established yourself, you have a track record, and we're willing to give you a line of credit based on your track record and your strategy. And ultimately, it may be, okay, let's go to the securitization markets where pension funds and insurance companies can invest in a pool at a super low interest rate. And that's basically the cost of capital curve. We see there's so many originators that are kind of going through that curve, that are moving through that curve. And there's gaps in that curve. And we think that Centrifuge can play a role there in terms of providing a low cost of capital and an increased access to capital. So early and emerging originators, we can typically provide a lower cost of capital than they can get in other places. And as DeFi scales, our cost of capital way down to compete with banks and potentially securitizations. And then from access to capital perspective, there's many different types of companies and industries and geographies that could use capital, and DeFi can help provide that capital. Centrifuge is in the business of structuring those deals, kind of like an investment bank, structuring the tranches and bringing the issuer's offering out to market for funding.
That's really cool. So what are the real world applications of the Centrifuge business and the chain? You mentioned real world assets. Which ones are we talking about?
Well, given our real estate connection here, let's talk about real estate. So one of the projects we have is with a company called New Silver that does real estate fix and flip loans for U.S. residential homes. So typically a developer is out there kind of identifying a new home that they want to purchase and then fix it up and flip. They will put between 15 and 30% down to provide a home, and then they take a loan out from New Silver for the balance. It's a bridge loan that lasts about 12 months. The yield on that loan is typically 10 to 12%, which is pretty standard in the bridge loan market, also known as the hard money lending market. It's a very popular space for like family offices and wealth advisors to participate in. It's only 12 months and it's a high yield. It's based on the fact that the developer is no one's going to live in the house during that time. Rather, they'll be renovating the home and getting it ready for livability. After 12 months, one of two things happens. Number one, the developer sells the house to somebody who's going to live in the house. Mm-hmm. And when they sell the house, they pay back the loan. Or number two, they rent out the house to renters and they refinance the bridge loan into a more traditional mortgage. Now that there's somebody living in the home, there's no more kind of construction risk associated with it. Either way, they exit the 12-month bridge loan and they go from 10 to 12% yield down to, if they're going to rent it out, more like 2 or 3% traditional mortgage. So New Silver provides that 12-month bridge loan. And basically, they use the Centrifuge protocol to tokenize each individual loan. Each loan creates an NFT, a non-fungible token. It's unique to the specific loan associated with the specific home and the specific developer. They'll put a pool of maybe like 20 or 50 or 100 together, and they'll put all of those NFTs into the Tinlake protocol. The Tinlake protocol will cluster all of those loans in one, and then create a senior tranche and a junior tranche. The senior tranche has a token called the drop token, and the junior tranche has its own separate token called the tin token. And both of those tokens earn a percentage of the cash flows coming out of the pool of NFTs. The senior tranche gets a fixed interest rate, and it's senior in the waterfall. So when all of the payments come back into the pool, those payments are first dedicated to the senior tranche, which gets paid first at their fixed interest rate.
Yeah.
After that, all of the remaining payments waterfall down to the tin tranche or the junior tranche, which takes the residual. The tin tranche acts as an insurance buffer. If, let's say, one of those homes fails, or one of those developers goes bankrupt or something, as the value of that NFT or that asset falls, the tin tranche will be impaired while the drop tranche will maintain its value.
Okay.
Tin tranche takes all of the losses until it's completely wiped out, at which point then the drop tranche could be impaired.
So the tin tranche will have higher interest rate then. Yeah.
High returns, higher risk.
Higher returns, higher risk. And the recipient of the loan is the developer, right? It's a development loan or renovation loan otherwise, right?
Well, technically, New Silver is borrowing from us. So the recipient of our loan is New Silver. New Silver then takes all the loans, all the money they get from us, and lends out to the developer.
Oh, I got it. So New Silver is a financing entity. It's a lender. Okay, I understand.
They're borrowing low, lending high, right? They're borrowing from Tinlake at 5%, and they're lending to borrowers at 10%.
Yeah, that makes a lot of sense. Okay, fantastic. And so they are responsible for actually rating these recipients, I guess, developers and so on and so forth, evaluating risk and stuff like that. So you're not taking any of that. You're just giving out a loans to a lender. But your investors, though, you do have responsibility to your community, right? So that the Silver Lake is going to be able to return those loans.
Well, technically, New Silver is using our infrastructure to launch their own pool to bring in their own investors.
Oh, got it. Oh, okay. Best case scenario.
Well, yeah, it's their investors and it's their pool using our infrastructure.
That's fantastic.
But that being said, when they deploy all the smart contracts, they basically we put them through a risk scorecard, which says that give us the range of interest rates that you will charge and the variables that will determine the different interest rates.
Yeah.
And then also give us what has been your historical track record in terms of a default. Actually, before default, what does it mean to be delinquent and what does it mean to default? If you're expecting a payment at the end of every month and the payment comes in 15 days later, or you're 15 days after the month and the payment hasn't come in yet, what do you do? Right? Most likely there's some type of markdown in the value of the loan because there's been a delinquency. That doesn't necessarily mean they're going to default, but there is some type of markdown, slight markdown. And as time goes on, that markdown gets greater. And there's a bunch of collections policies that go along the way with, okay, if it's only 15 days late, we're just kind of waiting. 30 days late, maybe they're calling and collecting. 60 days late, maybe they're hiring a collections agency. I don't know exactly.
There should be an administrator on this whole deal and that might take over. Yeah. Okay. Fantastic. But they're a traditional lender, so they should employ.
And all of the rules are baked into the smart contract. So 15 days we mark down, 30 days we mark it down even further, 60 days we default it.
That's awesome. I love it how this literally is the old school way done, totally new school. That not only you're providing a new capital or a new type of capital, but also you are changing the process inherently. You're providing borrowers some sort of assurance that whatever their lender promised will happen to a certain extent, right?
Can I talk about where it goes next?
Please.
Okay. So what I described is the risk scorecard. And the risk scorecard was made by the issuer upfront, disclosed to all investors so they know how the rules work, but the issuer made it, right? So the issuer is saying, my loans are worth 9% or 10% or 11%, and this is the category. This is when they fit this credit box, I'm going to give a 10% loan, right?
Yeah.
That's nice. But I think the next step is kind of what you referred to earlier. rolling out a pricing and risk oracle, as well as opening up underwriting to third parties.
Love it.
Well, the underwriter token, which is coming, would allow for a third party to build a risk scorecard as opposed to New Silver building the risk scorecard.
Got it. Like Fitch and kind of like rating agencies?
Kind of. A ratings agency is an agency that has no skin in the game. This would be somebody who actually makes an investment and also determines what the underwriting parameters should be for the loans that they are kind of funding themselves. So they're kind of making the credit box and then agreeing to fund the credit box. It's kind of like taking a lead as a venture firm that is kind of negotiating terms with the company, with the emerging company. And once those terms are set, then all other investors can follow. It's kind of like what the underwriter would do. They would kind of negotiate the terms with the asset originator, put them in place. And then the next part of that would be the oracle, which is where the data would come in. So third parties can provide data to the oracle. The underwriter could take the information from the oracle to create the risk scorecard that would be used by the asset underwriter. So it starts to kind of isolate and break up the job functions within the ecosystem.
You really are decentralizing the industry. I love it. All right, so let's talk about Tinlake protocol. What is that?
So everything I've just described is part of the Tinlake protocol. So there's the Centrifuge chain and there's the Tinlake protocol. We built Centrifuge on Ethereum to begin with, and we love Ethereum. I previously worked at Consensus. The co-founder of Consensus is the co-founder of Ethereum, and Consensus has built over 200 Ethereum-based companies. So I love Ethereum. I was trained in Ethereum, but I realized while I was there that Ethereum has a giant traffic jam that has started and it's going to get worse before it gets better. Ethereum is rolling out Ethereum 2.0, which will come in the next 2 years or so. But in the meantime, the traffic jam is going to get worse. And we at Centrifuge noticed that and said, we need to plan for this, because if we're going to do loans and invoices, I mean, the average Fortune 500 company produces 18,000 invoices per day. We're going to mint a token for every single one of those invoices. That's tens of thousands of invoices or tokens that need to be created per day. The gas costs to do that on Ethereum are going to be ridiculously high. So we kind of saw that coming, and we said, all right, we need a solution for this. We also want to control our own blockchain. We want to control our own destiny. As a result, we decided to build our own blockchain called the Centrifuge chain. We built it on Substrate, which is the framework used in the Polkadot ecosystem. So the blockchain is now built, and the blockchain is where asset originators will mint their NFTs. So every time they have a new loan or invoice that needs to be tokenized, they would use our token, they would deposit it into our blockchain, and through that, they would mint a token of their loan or invoice. That's what the Centrifuge chain does. Once the tokens are created, the NFTs are created, they then put them into the Tinlake protocol. The Tinlake protocol is an application or a dApp that sits on top of the Centrifuge chain. And the Tinlake protocol is specifically designed to take in a bunch of NFTs, pool them up, tranche them into a senior and junior tranche, and then help the issuer issue the tokens to the public.
Amazing. All right. I hope that was clear more or less to our listeners. I think that you definitely clarified those terms for me. I read on your website this term deep tier finance. What is that?
Oh, that's the dream. We're not there yet, but that is the dream. So actually my co-founders, my colleagues who co-founded Centrifuge, they previously co-founded a company called Thalia. And Thalia is one of the largest fintech companies, specifically in the world of supply chain finance. They're one of the inventors of something called dynamic discounting. Dynamic discounting basically is used by Fortune 500 companies with their tier one suppliers. And it says, if Walmart is buying Coke, then it will say, okay, if you want to be paid in 90 days, we'll pay you in full. But Coke, you can go in and basically use a slider and say, instead of 90 days, I want to be paid in 60 days or 30 days. And as you slide that slider, you'll see how much of a discount you will need to take in order to be paid earlier, right? That's dynamic discounting. Okay, they built that. And after they built that, it's worked really well. They have hundreds of billions of dollars that flow through that solution that they built. But what they realized was that Coke doesn't need any financing help from Walmart. Like, they can just go to their bank or whoever. Like, they have plenty of options, right? So, I mean, this is nice that it's here, but it's not like they need a lot of help. Who really needs help is the company that is 3, 4, 5 hops away from Walmart, that is feeding into the Walmart supply chain, but is not a big company and doesn't have direct connection with Walmart. That's the deep tier. And that deep tier will often have an invoice that's due, and they'll have to try to claim to a third-party finance company, but they're basically saying, hey, this invoice is going up the chain and Walmart's going to pay, and as Walmart pays, it's going to come down the chain all the way to us. And there's no belief that that's actually happening. There's so many cases of fraud, so there's no belief that invoice from this small little company ultimately starts at Walmart and will eventually get to them.
Yeah.
And as a result, the financing cost for factoring of a small business that's in the Walmart supply chain could be 40% or higher. And most of that is because of the lack of trust and the lack of information. So deep tier financing will allow us to associate deeper tiers all the way up the supply chain to the large buyers at the top of the chain. And as a result, hopefully that will bring down the cost of capital for those in the supply chain. Will also help with sustainability. So Walmart wants to have a healthy supply chain. They are always the weakest link. They always have to take care of the weakest link in their chain, otherwise their chain could fail. That little supplier may not supply the right product, widget, whatever it may be, and therefore the Coke may not be delivered on time. All right, so Walmart has to think about those things and deep tier financing. So my colleagues left Talia to create Centrifuge with this idea that deep tier financing must be solved, and the blockchain is the best way to solve it. So we haven't got there yet, but that's still a dream.
I love it. You guys have a vision, all the power to you. All right. Another clarification of terminology. What's the difference between an open and a closed blockchain platform?
Sure. So a closed blockchain platform is an exclusive private island. Somebody has created a blockchain, and the blockchain is like the private island that they own, and they invite all of their wealthy friends to join their private island. And they say, as long as you guys are here, we're going to play by these rules and we can do whatever we want. That's a private blockchain. It's basically a closed environment. All the people play together. It's not much different than just using a database with a certain number of players all kind of using the database together.
A lot of banks do that, right? Regulated entities.
Yes, that's a private closed blockchain. A public blockchain, number one, it's built on open source code for the most part, not always, but for the most part, which means that all of the code is completely transparent and readable and forkable if you want. It's there for the taking. You see exactly how everything's been built. Number two, the protocol or the blockchain is composable, which means that blockchain works with other blockchains and other software that's built on top of each other. So a lot of times it's called money Legos. There's many different protocols or blockchains or solutions that are being built that all kind of work together in unison in order to create an outcome. That's the money Legos. That's an open blockchain can work with other blockchains to produce things in unison. I can give you an example of that.
Mm-hmm.
So remember that New Silver deal that I told you about?
Yeah.
In that case, we take that senior tranche, which is stable and secure, and we think that is a really good asset for other blockchains, specifically for stablecoin blockchains. So we're really excited. In 2 weeks, we will launch a project with MakerDAO. We've been working on this for 2 years now, and it goes live in about 2 weeks, where we will take the senior tranche of New Silver and we will deposit it into a MakerDAO vault. And MakerDAO will take that pool of senior secured real estate and they will mint the DAI stablecoin against the collateral that they've put into their vault. This will increase the circulation of DAI stablecoin for MakerDAO. And from our perspective and New Silver's perspective, it will give a loan, low interest rate loan to New Silver in exchange for the collateral that they've pledged.
That is fantastic.
They take that loan in DAI, they convert it to USD, and they go out and they lend it to more borrowers.
That is so revolutionary to me. We Solid Block, we're a marketplace for tokenized properties. We've also been working with MakerDAO, but more on the consumer side, to consume the loans. And that's how we recently got put in touch with you, Jason, because of this specific thing that you're launching on MakerDAO, to see how we can also take advantage. But, we have different type of assets that we're hoping to feed into the MakerDAO ecosystem. I love the fact that they actually are one of the very few stablecoin I don't know how to call them, operators or platforms and networks, or all of the above, that are looking to diversify their collateral and to put real world assets. That's very exciting. I think you guys are playing a huge part in that as a bridge, truly the bridge between, real world and DeFi.
Yeah, I'm sure we're going to have a long, healthy relationship working together to where Solid Block will identify many different real estate projects. We can work together on kind of bridging them to DeFi.
Amazing. All right. So we're working on these revolutionary concepts that early adopters like New Silver and Solid Block are taking advantage of. Now, how can we make sure that mainstream lenders, mainstream issuers can take advantage of these technologies?
I'd say just give it time. And with time comes kind of history, track record, experience, and improved user experience. Right now it's hard. It doesn't all make sense. Everything is new and it's hard. It's not the user experience isn't great, but the fundamentals are there. So again, I feel like just like it's part of the internet. It's digitizing rules. It's putting them in a protocol. It's kind of rolling them out through a DAO. These are things that will be fundamental to commerce in the future. Right now, they are foreign concepts, but they will be fundamental in the future. It just takes time to get there.
Yeah, we just got to be patient, right? It's not our virtue in the blockchain and crypto industry. I have to tell you that. Being in all the crypto groups on WhatsApp and Telegram, that's not a part of our virtues.
Well, I was just going to say, you said at the beginning you wanted to talk about robo-advisors a little bit, right?
Yeah.
Because I feel like this is similar with robo-advisors. In 2008, I built one of the first robo-advisors, and I've just seen that evolution. And to me, a robo-advisor is basically a digitized hedge fund. It takes a hedge fund and it automates every process of the hedge fund, both the part that takes the money in and then also the part that trades the money, and then finally the part that reports to investors and then redeems the money when that has to happen. So it's just an automated hedge fund. So I think robo-advisors are really interesting, really cool. And I've seen them go from nothing to like some foreign thing, a robot doing your investing. Like my company, we own a company called Lending Robot. It's literally called Lending Robot. And that's what it does. It's a robot that invests your money for you. So we've gone from that to, I think DeFi is pushing robo-advisors to the next level, right? Instead of just fully automating a hedge fund like a robo-advisor, now they're layering a DAO on top of that. So there's a decentralized robo-advisor, which is decentralized hedge fund. That's what DeFi brings to the table.
But in this robo-advisor, and you're putting a DAO on top of that, you can incorporate also the wisdom of the crowd, right? And the brains of actual people.
Exactly. That's the decentralized nature of it. Yeah. You have more people participating, collaborating together, wisdom of the crowds in some cases. Sometimes that works, sometimes it doesn't. But generally, there's the DAO, it can be very flexible in terms of how it evolves over time.
Yeah, it's super exciting, hard to wrap your head around it. But I'm sure we'll talk again, maybe do another podcast about the specifics of that and more advanced information, if you will. For now, I'd want to hear from you about what should we look forward to with respect to Centrifuge, DAOs, in year 2021 and maybe even 2022.
Yeah. So like I said, we launched in November. We're up to about 10 million now as of mid-April. Growth has gone pretty well. I think it's going to really accelerate now that Maker launches. They're supposed to commit 5 million just on our first deal in the first month, and it should grow from there. So I expect our total value lock to really accelerate this year. Right now, people just don't know what we do or how it works. And probably if I come back in a year from now, most people will still be in that I have no idea what they do stage, but there will be at least more people in the ecosystem. It will still be a small ecosystem relative to growth. It's probably 3 years away from kind of any type of mainstream adoption or anyone really understanding what it is that we do. Oh, in the meantime, we're also launching our token too. That's probably going to happen in the next few months. I'm not going to say exactly when because we haven't announced that yet, but we're working on it and there will be a token launch.
What kind of a token is it going to be?
It's a token native to our chain, and it will be used for gas in order to power our chain.
Got it. So can we classify that as a utility?
Yeah.
Okay, amazing. So we'll be looking out for more info on that as it comes. For now, thank you for joining me on the Block Solid podcast today. Jason, it was great having you as my guest.
It's been a pleasure. Thank you, guys. Great questions.
Thank you. You can find us on Spotify, Apple Podcasts, or by visiting our website at solblog.co/podcast. If you enjoyed the show, don't forget to rate and review and spread the word. Thanks for listening. See you next time.